Right now, as you are watching this video, a 45-year-old psychological prison that has trapped the silver market since before most of you were born has finally been shattered. The legendary $50 barrier, a price level that represented both the tombstone of fortunes and the zenith of manias, a number etched into the collective memory of every precious metals trader alive, is now nothing more than a fading line in the rearview mirror. Silver has broken free. And if you do not understand why this breakout is different from every other rally that came before, if you do not understand the decades of history that created this moment, you will not be positioned for what comes next. We are not talking about $100. We are talking about $200 and beyond. And every single piece of evidence I am about to present to you is documented, verifiable, and sitting in the public record for anyone with the patience to look. I might be an Asian guy, AI avatar, but behind this presentation is meticulous, exhaustive research going through historical archives, court documents, regulatory filings, and institutional analysis to bring you the complete story that the mainstream financial media has either forgotten or deliberately chosen to ignore. This is not some AI-generated sloppy script thrown together to chase clicks. This is the result of piecing together a narrative that spans 5 decades, multiple market cycles, documented criminal activity, and the collision of 2 unstoppable forces that are now driving silver to levels that seemed impossible just a few years ago. Every claim I make in this video is sourced. Every reference is linked in the description below. If you want to verify anything I say, the evidence is waiting for you. Right now, as you are watching this video, a 45-year-old psychological prison that has trapped the silver market since before most of you were born has finally been shattered. The legendary $50 barrier, a price level that represented both the tombstone of fortunes and the zenith of manias, a number etched into the collective memory of every precious metals trader alive, is now nothing more than a fading line in the rearview mirror. Silver has broken free, and if you do not understand why this breakout is different from every other rally that came before, if you do not understand the decades of history that created this moment, you will not be positioned for what comes next. We are not talking about $100. We are talking about $200 and beyond. And every single piece of evidence I am about to present to you is documented, verifiable, and sitting in the public record for anyone with the patience to look. I might be an Asian guy AI avatar, but behind this presentation is meticulous, exhaustive research going through historical archives, court documents, regulatory filings, and institutional analysis to bring you the complete story that the mainstream financial media has either forgotten or deliberately chosen to ignore. This is not some AI-generated sloppy script thrown together to chase clicks. This is the result of piecing together a narrative that spans 5 decades, multiple market cycles, documented criminal activity, and the collision of 2 unstoppable forces that are now driving silver to levels that seemed impossible just a few years ago. Every claim I make in this video is sourced. Every reference is linked in the description below. If you want to verify anything I say, the evidence is waiting for you. Stagflation savaged the purchasing power of the dollar. Inflation rates that seem unthinkable today became the norm. Soviet tanks rolled into Afghanistan, threatening to destabilize the entire Middle East. American hostages languished in Tehran as the Iranian Revolution toppled a key U.S. ally. The palpable scent of fear hung over the markets, and into this chaos stepped 2 men who would change the silver market forever and whose legacy would haunt it for the next 45 years. Their names were Nelson Bunker Hunt and William Herbert Hunt, and they were about to attempt something that Wall Street believed was impossible. The Hunt brothers were Texas oil tycoons, heirs to one of the largest family fortunes in America. But unlike most wealthy men of their era who trusted the system, the Hunts looked at the unbacked dollar and saw a mathematical certainty of collapse. They believed that fiat currency was doomed, that paper money backed by nothing but government promises would eventually return to its intrinsic value of 0. And they decided to position themselves for that collapse by accumulating silver on a scale that had never been attempted before. What made the Hunts different from the paper traders of today was their absolute conviction in physical metal. They did not merely speculate with futures contracts. They demanded physical delivery. They commandeered airplanes to fly bullion across the Atlantic Ocean, storing mountains of 1,000-ounce silver bars in Swiss and American vaults. This was not paper speculation. This was a physical conquest of the silver market. By January 1980, the Hunt brothers and their partners controlled an estimated 250 million ounces of physical silver and futures contracts. Let that number sink in. 250 million ounces. That hoard was equivalent to more than a third of the entire world's private silver supply. They had achieved what Wall Street deemed impossible. They had cornered the silver market, and their relentless buying pressure, combined with the runaway global inflation of the era, ignited a nationwide firestorm that older investors still remember vividly. The price of silver, which had languished below $2 for years, began to climb. Then it began to surge. Then it began to explode. From $6 per ounce, silver rocketed to a breathtaking intraday peak of $50 in January 1980. In percentage terms, this surge eclipsed even gold's historic run during the same period. A full-blown public mania ensued. Americans who had never thought about silver in their lives suddenly became obsessed with it. Lines formed around the block at local coin shops as people rushed to cash in their sterling silver tea sets, their family flatware, their grandmother's heirloom candlesticks. The Hunt brothers had proven that silver was money, real money, and the public was desperate to convert their depreciating dollars into something tangible. But the Hunts forgot the cardinal rule of finance, a rule that every trader watching this video needs to understand deeply. You cannot corner a market that the establishment needs to control. The COMEX exchange, the major bullion banks, and the Federal Reserve looked at that $50 price and saw not a victory for free markets, but a systemic threat to the entire banking sector. The Hunts were not just making money. They were exposing the fragility of the paper system. They were proving that when enough people demand real metal instead of paper promises, the system cannot deliver. And the establishment decided that this lesson could not be allowed to spread. In a concerted, ruthless maneuver that forever altered the silver market, the exchange changed the rules in the middle of the game. They instituted what became known as Silver Rule 7, a liquidation-only trading policy that meant traders could only sell their positions, not buy new ones. They restricted leverage in the commodities futures market, specifically targeting the Hunt brothers' ability to maintain their massive position. The Hunts, who had built their fortune on leverage, suddenly found that same leverage turned into a weapon against them. They could no longer buy. They could only sell. And the selling had to begin immediately because the margin calls were coming. The trap was sprung with surgical precision. The margin calls began, a relentless billion-dollar drumbeat that the Hunts could not escape. Every day brought new demands for cash to back their positions. Every day brought forced liquidation of holdings they had spent years accumulating. And on March 27, 1980, a date that would be remembered in financial history as Silver Thursday, the Hunt brothers capitulated. The price of silver cratered by over 50% in a matter of days. A multi-billion-dollar fortune evaporated. The Hunts, who had bet everything on hard money, were crushed by the very paper system they so deeply distrusted. But the most lasting damage was not to the Hunt brothers' bank accounts. It was to the silver market itself. The $50 mark, which had been a triumphant peak, was transformed into a tombstone. It became a ceiling of extreme psychological resistance that would haunt the market for generations. For 45 years, every time silver approached that level, traders would remember what happened to the Hunts. They would remember that the establishment would not allow silver to trade freely. They would remember that the rules could be changed at any moment, and they would sell, reinforcing the barrier with each failed attempt to break through. I want to pause here and ask you something. Did you know this story before watching this video? Did you know that the $50 level that silver just broke through was created not by natural market forces, but by deliberate intervention to crush traders who dared to demand physical delivery? Drop a comment below and let me know. And if you are finding this historical analysis valuable, make sure you are subscribed to MRAG Asian Guy with the notification bell turned on. We are just getting started. The years following the Hunt brothers' collapse were brutal for silver. Just as it did for gold, the Volcker shock of the early 1980s proved lethal to silver's monetary appeal. Federal Reserve Chairman Paul Volcker raised interest rates to an unprecedented 20% to break the back of inflation. When you can earn 20% risk-free by holding treasury bonds, why would you own a metal that pays no interest at all? The opportunity cost of holding silver became impossibly high. During the subsequent 20-year bear market, silver was demoted from its status as a monetary metal. It was stripped of its prestige and viewed almost exclusively as an industrial commodity. Its price action began to resemble copper or zinc rather than gold. The price plummeted from its manic peak, eventually bottoming out below $4 per ounce. For an entire generation of traders who came of age during this period, the idea of silver as money was not just forgotten, it was considered absurd. Yet even in the darkness of this 20-year bear market, the smart money saw value. In 1997, stealthily and without fanfare, the Oracle of Omaha himself began accumulating silver. Warren Buffett, through Berkshire Hathaway, purchased 129 million ounces of physical silver. This was a significant portion of the world's known supply at the time. Buffett recognized what the mainstream had forgotten. Supply and demand were out of balance. More silver was being consumed than was being produced. The price was artificially depressed by sentiment rather than fundamentals. One of the greatest investors in history was quietly loading up on silver, while the rest of the world dismissed it as a relic. Compounding the decline for the broader market, the rise of digital photography began the slow, inexorable decay of silver's then primary industrial use. Photographic film, which had consumed massive quantities of silver for over a century, was being replaced by digital sensors that required none. This transition seemed to confirm the bear thesis. Silver was not just monetary irrelevance, it was industrial obsolescence. The metal appeared to have no future. But the smart money, as always, was looking ahead while the crowd was looking backward. And the seeds of silver's resurrection were already being planted. Silver's reawakening came alongside gold's in the wake of the dot-com bust and the geopolitical uncertainty following September 11, 2001. As a much smaller, less liquid market, silver's price movements began to display their characteristic leverage. When gold moved 1%, silver often moved 2 or 3%. A modest flow of investment capital could send silver's price soaring with far more velocity than gold. For traders seeking maximum exposure to the precious metals thesis, silver became the weapon of choice. The true catalyst, however, was the 2008 global financial crisis. When Lehman Brothers collapsed and the entire global banking system teetered on the edge of oblivion, central banks responded with a policy that would have been unthinkable just years earlier: quantitative easing. Trillions of newly created dollars flooded the system. The Federal Reserve's balance sheet exploded from hundreds of billions to trillions, and this tsunami of new money fully reignited silver's dormant monetary appeal. Silver became the poor man's gold, an accessible haven for those who felt priced out of gold, but were desperate for protection from currency debasement. Investment demand, particularly through newly created silver ETFs, flooded back into the market for the first time in decades. This wave of buying powered the second great assault on the $50 fortress. From a low of around $9 during the depths of the 2008 crisis, the price surged relentlessly higher. By April 2011, silver had reached a dramatic peak of nearly $49.50 per ounce. It was a near-perfect, agonizing echo of its 1980 high. Once again, silver fell just short of $50. Once again, the psychological barrier held. The legacy of the Hunt brothers, the memory of what happened to those who dared to push silver past that forbidden line, proved too powerful to overcome. Traders who remembered 1980 sold. New traders who had learned the history sold. And the price retreated, reinforcing the profound psychological power of that $50 mark for another generation. The years following the 2011 peak were brutal. As central bank liquidity flowed into a historic stock market rally that would eventually produce the longest bull market in American history, silver was left behind. The consolidation that followed was no mere market cycle. It was a war between two opposing forces that would build pressure for over a decade until one finally broke. On one side of this war was the paper market, and what happened in the paper market was not conspiracy theory. It was documented crime. While the public saw a boring, range-bound metal going nowhere, a criminal enterprise was being operated in broad daylight. For nearly a decade, traders on the precious metals desk at JPMorgan Chase, among other major banks, engaged in a massive spoofing campaign designed to suppress the price of silver. Spoofing is a form of market manipulation where traders place enormous fake orders with no intention of executing them. These phantom orders create the illusion of massive supply, driving prices down. Once the price drops, the spoofers cancel their fake orders and buy at the artificially depressed level. This was not speculation or accusation. In 2020, JPMorgan Chase was forced to pay a record $920 million to settle United States government charges for this manipulation. Let me repeat that number: $920 million. That is the largest fine ever paid for market manipulation in the history of the commodities market. The bank admitted to placing hundreds of thousands of orders for precious metals futures contracts that it had no intention of executing, with the express purpose of deceiving other market participants and manipulating prices. For years, the paper price of silver that you saw on your screen was not a real price determined by genuine supply and demand. It was a fiction, a manipulated number designed to benefit the banks at the expense of honest investors. I want you to sit with that fact for a moment. The price of silver was being criminally suppressed for nearly a decade by one of the largest banks in the world. And they were caught, and they paid nearly $1 billion in fines. And yet, how many people watching this video knew about this before today? How many people understand that the price action they watched during those years was not a free market but a controlled demolition? Drop a comment below and tell me. And share this video with anyone who still thinks that silver manipulation is a conspiracy theory rather than documented, prosecuted fact. But while the paper price was being smothered in New York and London, something extraordinary was happening in the physical world. While investors scorned silver, while the mainstream dismissed it, the technological revolution was quietly embracing it with an intensity that would change everything. Silver's unmatched electrical conductivity, the highest of any element on the periodic table, combined with its superior thermal conductivity and durability, made it irreplaceable for the technologies that would define the 21st century. The engines of this new demand were relentless and unstoppable. Solar photovoltaic systems, the backbone of the global green energy transition, require silver paste sintered onto their cells to conduct electricity efficiently. Every solar panel installed anywhere in the world contains silver, and the world was installing solar panels at an exponential rate. Electric vehicles, which were transitioning from curiosity to mainstream transportation, required silver for their battery connections, their electronic systems, their charging infrastructure. Every circuit board in every smartphone, every computer, every piece of electronic equipment contained silver. The rollout of 5G communications infrastructure required silver for its superior signal transmission. Medical technology, from diagnostic equipment to antimicrobial coatings, consumed silver in growing quantities. Here is the crucial point that separates silver from most other commodities. This industrial demand is almost entirely price inelastic. A solar panel manufacturer must have physical silver to build their products. An electric vehicle company must have physical silver. A semiconductor fabricator must have physical silver. The cost of silver represents such a tiny fraction of the final product's price that these industries will pay whatever is necessary to secure the metal. They cannot substitute, they cannot wait, they cannot do without, they must buy. During the lean years when silver was being suppressed in the paper market and scorned by investors, this ravenous industrial consumption created a structural supply deficit. More silver was being consumed by industry than was being produced by miners worldwide. The world's vast above-ground stockpiles accumulated over centuries were being relentlessly drawn down. Every year the deficit continued. Every year the available supply shrank. The spring was coiling tighter and tighter, storing energy for an eventual release that would be explosive. The monetary tsunami unleashed in response to the 2020 pandemic was the final catalyst. Central banks around the world printed more money in a few months than they had in the previous decades combined. The Federal Reserve alone expanded its balance sheet by trillions. As this flood of new currency entered the system, silver finally awoke from its decade-long slumber. But this time was different. This time, the awakening was not driven by just one factor, but by the collision of silver's two identities. Two immense, unstoppable forces began hitting the market simultaneously. On the monetary side, investors watched gold break to new all-time highs and became terrified of permanent currency devaluation. They poured back into silver as the ultimate leveraged alternative to gold. If gold was going up, silver historically went up faster. For investors seeking maximum protection against currency debasement, silver was irresistible. On the industrial side, the global green transition and the relentless march of technology meant that industries now had to acquire physical silver not as an option, but as a necessity for their very function. Solar installations were accelerating. Electric vehicle production was ramping. Data centers for artificial intelligence were being built at unprecedented scale. The industrial complex was competing with investors for a shrinking supply of physical metal. It was the perfect storm, a speculative rush from investors crashing into a physical supply squeeze from industry. The price surge that followed was not just a rally. It was a complete reevaluation of what silver was worth. And when the price finally broke decisively above $50, shattering the 4-decade psychological barrier that had contained the market since the Hunt brothers' destruction, it confirmed that a new secular bull market had begun. The tomb had become a launching pad. This brings us to the present moment and the question that every silver investor needs to answer. Where does silver go from here? Based on my analysis of the historical forces that created this market structure, the documented suppression that artificially depressed prices for years, the structural supply deficit that has persisted for 6 consecutive years, and the collision of monetary fear with industrial necessity, I believe we are in the early stages of a move that will take silver to levels that seem almost impossible from today's vantage point. We are talking about $100, we are talking about $200, and potentially we are talking about levels beyond that. The logic is straightforward once you understand the forces at play. Silver's bull market is being propelled by two powerful engines, not just one. The first engine is the same financial fear that drives gold. Currency debasement, fiscal irresponsibility, geopolitical chaos, loss of trust in the financial system. All of these factors drive safe haven demand into precious metals. When gold rises, silver historically rises faster because of its smaller market capitalization and higher volatility. The second engine is the industrial supply crisis. Regardless of what happens with investor sentiment, the factories must have silver. The solar panels must be built. The electric vehicles must be manufactured. The data centers must be constructed. This demand is not optional. It is structural and growing. Here is what makes this setup so powerful. If one engine falters, the other continues to drive prices higher. If investor demand cools temporarily, industrial demand keeps consuming the shrinking supply. If industrial demand slows during a recession, monetary fear intensifies as central banks respond with more money printing. The two engines provide redundancy. They provide resilience. They provide a floor under prices that did not exist in previous silver rallies. For traders watching the technical levels, the picture is equally compelling. According to the latest analysis, the key stop order levels that professional traders are watching create clear zones of potential price acceleration. Buy stop orders, which trigger buying when prices rise through key resistance levels, are concentrated above recent highs. Sell stop orders, which trigger selling when prices fall through key support, are concentrated below established support zones. When price breaks through these levels with momentum, the triggered stop orders add fuel to the move. Understanding where these stops are located gives active traders a significant edge in anticipating where buying or selling pressure will intensify. But beyond the technical levels, the fundamental picture is what truly matters for the long-term trajectory. The supply deficit has now persisted for 6 consecutive years. The exchange inventories have been drawn down to historically low levels. China has implemented export licensing restrictions on silver, limiting which companies can even ship the metal out of the country. The manipulation that suppressed prices for a decade has been exposed and punished. The psychological barrier at $50 has been decisively broken. Every factor that held silver back for 45 years is either resolved or reversing. I want to hear from you now. Based on everything we have discussed in this video, what is your price target for silver? Do you think we reach $100 this year? Do you think 200 is realistic? Do you think we could go even higher? Drop your prediction in the comments and let us see how the MRAG Asian Guy community views this market. And if you have been holding silver through all the years of frustration and suppression, I want to hear your story. How long have you been stacking? What made you believe when the mainstream said silver was dead? Your experience is valuable to everyone watching. Let me give you some perspective on what we have witnessed and what it means for the future. The Hunt brothers tried to break the $50 barrier in 1980 and were destroyed by a system that changed the rules to stop them. The 2011 rally came within cents of $50 and failed, crushed by a combination of paper manipulation and psychological resistance. For 45 years, that level stood as a monument to the power of the establishment to control silver prices. And now it is gone. The barrier is broken. The psychological prison that held silver captive for nearly half a century has been shattered. This is not just a price breakout. This is a generational shift in the silver market. The forces that created the $50 ceiling, the memory of the Hunt brothers' destruction, the active manipulation by major banks, the widespread belief that silver could never be allowed to trade freely, all of these forces have either been overcome or exposed. The market is fundamentally different from what it was in 2011, in 2008, in 1980. The industrial demand did not exist at these levels. The supply deficit was not this severe. The manipulation had not been prosecuted and penalized. The convergence of factors we see today is genuinely unprecedented in the modern history of the silver market. For everyone watching this video, the question is not whether you believe the thesis, the evidence is documented. The question is whether you are positioned for the outcome. Are you holding physical metal that you can touch and verify and store securely? Are you prepared for the volatility that always accompanies major moves in the silver market? Are you connected to a community that can help you stay informed and stay grounded when the mainstream media tells you to sell? If you are part of the MRAG Asian Guy community, you are already ahead of the curve. Make sure you are subscribed with the notification bell turned on. Join our WhatsApp community for real-time updates. Follow us on X for instant commentary when markets are moving. The 45-year trap is broken. The forces of fear and physics are aligned. The monetary demand is surging. The industrial demand is inelastic. The supply deficit is structural and persistent. The manipulation has been exposed and punished, and the price of silver is finally free to discover its true value, determined not by paper games and psychological barriers, but by the fundamental reality of a metal that is both ancient money and irreplaceable technology. The move to $50 was not the peak, it was the beginning. The next phase of this journey will be marked by public awareness as the mainstream media finally catches on to what precious metals investors have known for years. And when that public awareness arrives, when the average person realizes that silver is both a store of value and an industrial necessity in permanent shortage, the buying pressure could push prices to levels that seem unimaginable from today's perspective. $100 is coming, $200 is possible, and beyond that, the sky may truly be the limit. This is Mr. AG Asian Guy. The great repricing is not coming, it is here. The 45-year prison is broken. Silver is finally free. Stay informed, stay rational, and stay stacking. I will see you in the next video.